That was a hassle and a half. All right. Hi, guys. All right, so here we are. Now, unfortunately, since the thing made me reboot my computer, we have lost all of our historical virus information. So we have no idea where we were. I don't remember, frankly. But let's take a look. Let's see if I can go back to last Wednesday, and we'll take a look and see where we are. You know, and I don't like talking about the virus all the time, but I'm sorry, but I just, right before this webinar started, we're having another conversation where, I'm trying to just keep people real on where we are. Coronavirus cases in the U.S. Oh, that didn't count. There must be a map or something that day. La da 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 da. Boy, look how much stuff we have in chat. Jesus. It was just last week on Wednesday. All right, well, there was nothing. What do you know? Cases. All right. Okay, 609. There you go. We had 609 as of last week. So now I can close all these because they're all useless now. What a shame. We had such a nice track of all the virus things historically. So we had 609, now we have 830. We're still going at a very alarming pace. That's obviously up 35, 40, in the 35 to 40% range of growth of virus cases. Certainly not good. And several states are reopening, which is horrifying. And as I was saying in chat, we were just talking about it. So we'll start with this and move on to happier topics. So, who said it? I forgot. This is what sets me off every time. So somebody says something and I'm like, no. Okay, here we go. So Advil says, he goes, looking at the graphic, I realize the US is much better in comparison. I guess he's talking about the big graphic for the virus. Oh, well, I'm sure he means the big graphic for the virus. Oh, wait, what was that? So US has 46,000 deaths, but blah, blah, blah. Okay, so look, here's the big graphic. US has 46,000 deaths. If you click on US alone, 45,600 deaths. And he says most of it is concentrated in a small area and so on and so forth. Now, here's the thing though. It's not that most of the deaths, and these are the virus cases, not the deaths, but it's basically the same thing. Most of the deaths they're 1/3 of our deaths are in New York City right now. Why? Because the hospitals in New York City got overwhelmed. They weren't able to adequately treat people. It has a high percentage of older population and a lot of air pollution. Everybody is breathing in soot all the time because of all the cars. You live where cars are constantly making pollution. That's one of the worst conditions for coronavirus because it chips away at the lining of your lungs and it allows the virus to get ingrained there and really cause some serious damage. That's why polluted cities like Hong Kong, not Hong Kong, sorry, polluted cities like Singapore and China and so on and so forth got hit pretty hard, and all around the world. In Italy, you're seeing that and things like that. And in cities where there's a lot of pollution, you're getting a lot of virus. Rome is another place, a lot of virus, a lot of old people, a lot of pollution. That's the worst possible situation you can have. But meanwhile, if you look at the map of infected people, and you look at the map, this is the population density of the United States, and here's a map of the infected people in the United States. It's the same map. No one's exempt from the virus. You're exempt from people. Okay, look, see that spot right there? That's that spot right there. It's a little, I mean, this map didn't come out very clearly for whatever reason, but here's a spot, here's a spot, here's a spot, here's a spot. Everything corresponds to the population. You should be super concerned about these because these shouldn't even register on the map. Why aren't these white? These guys are pretty much white. Why are these places not white? Okay, that means you're getting some alarming numbers of people here in low populated areas compared to what's going on over here, for example. You know, similar population to, you know, this area here has a similar population to this area here, yet this area here is got all these little spots. Every little town, county, whatever has some people with the virus. Now, why is that? You know why? Because people don't go from San Francisco to frickin' Idaho very often. Not many people go from, you know, these guys are all coastal. And you can see the spread of the California stuff up and down the coast. These guys go up and down and they go to Vegas, right? That's where else do they go? They go to Vegas, they go to, you know, they'll go to, I guess they'll go to Salt Lake City and whatever, but this is the commerce lines of California. So you can basically see this is what's being caused by air travel, by business travel, so on and so forth. There's not a lot of business being done in Montana, Idaho, and whatever. And Wyoming feels like they're exempt, but they're not because they've got a huge problem in Denver that's spreading their way. And they got a huge problem in Salt Lake City that's spreading their way. So, you know, Wyoming is an empty state. So, of course, they don't have a lot of virus cases. But per capita, they do have a serious problem. But the thing is, the advantage of places like Wyoming is they're not being overwhelmed in their hospitals because they have a low population and because there simply aren't that many cases. They're already social distancing because they don't live anywhere near each other. You know, so they're accidentally following the guidelines. But that doesn't mean that they should all, you know, go to the Packers game next week. What are you doing? My phone thinks I'm asking something. So, you know, that's not a good reason to run out and go to sporting events or have concerts and such, right? Even worse, you're attracting people when you go to sporting events and whatever. You're attracting people from the places where there's a lot of virus infections to infect the people who aren't infected. Think of how stupid that is. The best way to get the people who aren't infected in Montana and Idaho, right, and Wyoming and South Dakota, the best way to get those people infected is to go to a fucking Denver Broncos game. Have a Denver Broncos game and let all these people go and say, oh yeah, the Broncos are playing. Come over here, watch a football game, and then go home to your farms and all that shit and go to your farmers markets and then infect your town. Like, yay, we finally found a way to infect your whole town. It's frustratingly stupid. I mean, I just really, I don't even know what to say about it. It's just so amazingly ridiculous, and we're doing. It's like we're like, I don't know. We're like a third world country. I mean, we're like we are worse than a third world country though, because there are third world countries that aren't as stupid as we are. We can see them. They're not doing what we're doing. Stiglitz was talking about that today, and he says the U.S. response to the virus is like that of a third world country. Let's see, Stiglitz virus. I don't know, but these are all older. He's been saying a lot of stuff apparently. Stiglitz virus. Third world. Oh well. Anyway, it was a good quote there. He's talking about just like we're responding like a third world country would respond. Like you would we're responding like you would think a third world country would respond. You know, it's ignorant, it's not science-based, we are just basically going on rumors and innuendo. We're trying stupid miracle drugs because nobody listens to the people who are scientists who get on TV and tell you that this is not going to work. They did a study on the thing Trump was trying to tell everyone to take. I forget what it was called, but whatever it is, it was bullshit. Turned out to be complete bullshit. Doesn't work at all. And you think it's not a big deal. It's like you say, no, so what? So the president says to take the thing and it doesn't work. It's like, yeah, but you know what? When you think something works, then maybe you don't fund something, or you make a decision that's not to promote something or to do a real test in a real lab. Okay, because you know what Trump's attitude is. It's like people, the scientists that come to him and say, we're going to need $1 billion and it's going to take 14 months for us to come up with a cure, but we got a good handle on it. We're pretty sure it's going to be done in 14 months. And then somebody else comes to him and says, I have a miracle cure. It'll be ready in 3 days. I need the same $1 billion. Where do you think he's allocating the money? He's a sucker. He's making us suckers. We're not funding solid science. We're not following solid science. We're not doing the right thing. And people are dying. And it's obviously since last week there were 600,000 cases, and now there's 825,000 cases. So since last week, 200,000 more people got infected. Okay, I didn't do it. You didn't do it. Somebody did it, though. Somebody somewhere in America got infected in the last 7 days, despite the lockdown. 200,000 more people in 7 days, 30,000 people per day are getting infected, despite the lockdown we have so far. Therefore, to decide not to continue to have a lockdown is probably not the idea. You could, I guess, say, well, lockdown clearly doesn't work, so fuck it. But, which seems to be our attitude. But the point is that scientists will tell you that if we weren't doing the lockdown, it would be 100,000 people a day. It would be 200,000 people a day, and the hospitals would be completely overwhelmed. And instead of only 45,000 people dying, which is a ridiculous thing to say, since that's effectively how many people died in the entire Vietnam War. Okay, how many people? I think 60,000. How many people died? Well, not people really, Americans. But I bet that's what we're going to get in the Vietnam War. Let's see. We're going to talk about America. See, there you go. That's gay Google. So they're talking about how many people actually died. How many Americans died is the question, though. Vietnam War casualties. La-di-da-di-da. Total number of deaths. United States Armed Forces. 50, a little less than 60. So 56, 57, 58,000, somewhere in that range. So basically, we're getting up to about how many people died in the Vietnam War, except the Vietnam War, oh, where'd it go? The Vietnam War was from, I don't know, a long time. Let's see, 55 to 75 is technically a 20-year war. So in 20 years, almost 60,000 people died. We're clearly going to go past that, but the point is, this number accelerates over time, doesn't decelerate it, as we're nowhere near a peak yet. So the number accelerates over time. And, even when you flatten the curve, and this is not what you call a flattened curve, these are not good numbers. Oh, look, this is interesting. We can do this. 823. And how much is this? These are days. All right. What's today? The 22nd. So we want to go back to the 15th. The last webinar was 6:36, or whatever time of day they decide to take that number. And then if we go back to the 7th, 400,000. So we went from 4 to 6, and now we're at 8, so we are slowing a bit. All right. And before that, I forgot what date that was now. Oh, well, now it's all confusing. And before that was 2. So we were 100%, 50%, and then 30%. 100% gain in 1 week. Then we went to a 50% gain the following week. And now this week we're at a 30-something% gain, maybe 35% gain. So if we can knock that down to 20%, 10%, 5%, that's how you're winning. And that's when the lockdown is working. The lockdown is certainly effective, but not necessarily to say that you're done with it, because you can go right back on that bad path. And like I said, just think about it. Here you go. What is the, see, when you look up close, it doesn't look that bad at all, right? So here's Denver. I don't know if that's going to tell you. Oh yeah, Denver, 2,000 people in Denver have the virus. Okay. So what's the dumbest thing you can do? You send you open up a football stadium with 50,000 people, and you have them all go to the stadium, and then you're almost guaranteed that at least one of those people is going to be infected. And that's that we know of, by the way. These are confirmed cases. They're not all the cases. California just did a study. They tested a whole city, a small city, but it's like a city with like 4,000 people. They give 4,000 tests, and they found out that 4% of the people were infected. 4% of the people in America would be 12 million people. Not 800,000, 12 million. So California, who had the normal amount of virus cases, believed that they had a 1% infection rate, and it turns out they have a 4% infection rate. This is only a 830,000 out of 330 million is a 1 in 400. So you're looking at a 0.25%. So we believe in the United States that we have a 0.25% infection rate. We may actually have a 4% infection rate. That would be 16 times more than we think. And that would be 15 million people if we look at that. So since we don't know, we should act as if we're still worried, but we're not, are we? All right, so that's, you know, that's my attitude. I think look, yes, we are making progress with the lockdown. So support the lockdown. And that's the thing. The government should be 100% supporting the lockdown. And it's not. It's, you know, as we can see, it's all over the place. So this is a very dangerous thing. So that's then going to affect my market thinking, because I'm not going to be bullish when I think that we're going down the wrong path. I'm still concerned. So we're still very, very much into our hedges. All right. Now, it seems wrong at the moment because you have another $500 billion stimulus coming. Not today, apparently. They're going to vote on it tomorrow, I think, for the final thing. But this week, another $500 billion on top of all the other money that was put in. Will it make the big difference? I mean, it's at least getting close to accomplishing the original goal, which was to get us through a 2-month crisis. But if we're getting out too early and we have to re-lock down everything, then there's nowhere near enough money. We're only planning for 2 months, and if we take less than 2 months, go back out and remove the social distancing things and so on and so forth, even if we only do it in some places, when is it ever going to get better? In every town, everywhere, there are infected people. All right. I mean, obviously, clearly, if you live here, you can't even go outside. All right. The states that are removing restrictions are like South Dakota and stuff like that. South Dakota, Minnesota, I think, though, unfortunately, is on the list. They shouldn't be. I think Michigan was talking about it. That makes no sense. Look at Detroit. How could you remove how could you remove restrictions when you've got this much in Detroit? This is insane. Chicago's right next to you. It's crazy. The goal is you don't want to get like this, not that you want to get like this. And of course, it goes back to that same thing, though. Population density is going to help prevent you from getting as big. You can't get as bad as New York, but this is a metro area. This is from Washington, D.C. to Connecticut, basically. This is the New York metropolitan area, all the way out to Philadelphia. These are all people that commute back and forth and what happens? What do these people have in common? There's no population here. This is where I live. So I used to live anyway. Look, nobody lives here. All right, these are complete hick towns. Yet they are much more infected than like, you get out in Pennsylvania. These are as hickish towns as these towns are out in Pennsylvania. But the difference is they drive down this road to go to work, and they work in New York City. And this is what happens to you when you come in contact with big cities. This is Philadelphia. These are the surrounding suburbs of Philadelphia. These are the suburbs. This is suburban New York. This is what happens when you have a big city and you let people come in contact with a heavy concentration of virus people. So when you're in Michigan and you say, well, let's open this thing back up and let people go to Detroit and let people go around Chicago and so on and so forth, that's freaking insane. This is dangerously stupid behavior. And, saying that you're declaring victory and saying you're going to open things back up is great to goose the market for a few days. But the question is, what's the long-term implication of that? And we don't know for sure. I'm just saying this is what I think this is a bad case. It's possible that we could open things up and it'll turn out okay. It's possible the most susceptible people are the ones that are showing up with viruses and so on and so forth, and that probably maybe 75% of the population has little or no, they might get the virus, but they have little or no indications from it. It's almost nothing. Not even a cold. Like they have no idea they even had it. It's possible. They're not sure. They don't know enough yet. But that's the administration is counting on. And if they're wrong, the problem is it's a gamble. If they're wrong, we're completely screwed. If they're right, great. But you know what? If they're wrong about being overly cautious and then we come out and we're fine, or if either way we're fine, if they're more cautious, it doesn't make sense to not be cautious. There's no profit in the gamble. But that's where we're at. All right, so now back to the market. So we're done with that. So we don't know what's going to happen exactly. You got to be concerned. All I can say is just keep your hedges. Make sure you're hedged. In the short-term portfolio, we have $300,000 worth of hedges. When I say $300,000 worth of hedges, the earnings portfolio, short-term. See, and they're taking a hit every day. They're down to 529. We were at like 540, 550. $300,000. Now, when I say 300,000, what that means is that if the S&P, if the indexes, if the S&P and if the NASDAQ drop 20%, then the amount that we expect SDS and SQQ to go to would be up. It would be up 40% for SDS, so 25. Where's my calculator? All right. Obviously, 25 times 1.4. But see, what was that? Let's try it again. 25 times, so it's at 25 now, times 1.4, 35. All right, so we would see SDS go to 35, not 40 actually. Now for SQQ, same thing, except that it's 60% because it's 3 times ETF. So it's 13 times 1.6 takes you to 20.8, and we're at 25. All right, so actually 20% drop won't give us $300,000, but but up to, if it falls further than that, we'd have more of a hedge. And that's because obviously the indexes have come down and they're not as low as they were. But that's how you calculate what you're going to get paid. And that's why we make our adjustments though. So when I do see that and I say, okay, well, it's 5 out of the money here and 5 out of the money here, that's manageable, but not great. But at a certain point, you have to say this hedge isn't enough. So right now it is enough because we'd be looking at collecting 50,000 less there and 50,000 less on this spread and 50,000 less on that spread. So we would be looking at collecting 150,000 less. That doesn't make sense. Well, we would collect 15,000, right? We know it's 35, so we would collect 150,000 on this spread total, and the current total of the spread is 40,000. Therefore, plus 110,000. Oh, I see. I already did that math. That's why it's not minus 50. I already did the math for the lower numbers, for the lower targets. So ignore everything I just was confused about. In other words, so this thing, 13, and the NASDAQ, 13 times 1.6, 13 times 1.6 is 20 or 21, but whatever. But it's 20. So I counted this as being a 70,000 spread, not counting it as a bigger spread. It's a 70,000 spread. And the maximum payout would be 50,000 more than where it is. So this one will pay you 100, this one will pay you 50, and this one at 100, at 10, going to 20 would pay off 100,000 too. So 250. So currently you have $250,000 worth of payouts. The net of the payouts are 40, and I'm sorry, the net cost of that is 40 plus 15. Let's say that's 55,000, and these guys are 60 minus 20 is 40, minus 10 is 30, minus 16 is 15. Now I forgot what I said up here. Was it 45? 40, 55. 55 plus 15 is 70. So it's 180,000. So then, yeah, the net would be 180,000 for these two spreads. So how much are the spreads worth now? Obviously, what do they cost now? Versus how much do you expect to gain on a 20% drop? And that's a number you have to be comfortable with. So we're going to be plus about $200,000 as they're laid out now. So they got worse since the weekend when we were looking at them. And so at that point, I have to then look at the long-term portfolio and say, well, how much damage will the long-term portfolio suffer and not just, by the way, I keep saying that it's not just the long-term portfolio. This goes for any of our long portfolios. This is how we're hedging. We have a separate portfolio to hedge. So the long-term portfolio is currently right at $500,000, which is where it started. So the long-term portfolio is flat, and the question is, what's going to happen to the long-term portfolio if the S&P drops 20%? I think the long-term portfolio will lose roughly 40% of its value. Probably lose twice as much as a drop in the S&P. So we're only going to be mitigating half the damage. That means that really, if I get nervous about the market, and I'm not nervous on an up 400 day, but if I get nervous about the market, I'm going to want more hedges, or not so much more hedges as to adjust the hedges we have. So let's talk about that. But it's, you've always got to be looking and thinking and saying, where am I? How much of a drop do I expect is realistic? What's going to happen? And of course, we got to look at, this is where the big chart comes in handy, right? Because we look at the big chart. I know it's in there somewhere. Where was it? What? We didn't do a big chart today? How weird. I could have sworn I saw it. All right, no big chart today. Well, let's take a look at the other thing then. We'll look at the S&P. Look at this chart. So the question is, what are my fears? Right now, we're not at that. We're at the S&P is at, a second. The Russell's at the 1200 line. That's interesting. NASDAQ 85. Oh, for God's sake, it takes so long on CNBC to find out what something's at. S&P's right about 2,800. So just a little bit higher than it was. So the S&P is coming up here, the 50-day moving average. So what do I think is going to happen bad? If we fail the 50-day moving average, we are probably going to, well, we're certainly going to go back to 2,700. We're probably going to go back to 2,600, which is a 10% line, and the week retraces both in this area, in this 25, 26 range. The 10% line is like 25.50. The week retracement is 2,600. We're most likely going to test 2,600 if we come back down. See how 2,600 is kind of a little consolidation here too. So if we can't get over this 50-day moving average on the stimulus, especially if given five, see, here's the thing, it's like science, right? It's like a rocket. If I put $500 billion worth of fuel into this rocket and it fails to get over this line of resistance, then the rocket will plunge back to Earth until another force is applied or until it hits whatever the ground is. Now, do we think the ground is here? You know, a lot of these stimulus measures will take time to kick in. People haven't even gotten the first round of checks yet. So how can you expect buying to increase or anything else to happen when nobody's even got their money? But I think certainly 27 isn't going to hold though. And then we're going to be back at 26 and maybe 25. I think this was not deserved given how much money is being put to the problem and given that the problem hasn't gotten appreciably worse. In other words, a month ago, we were expanding at about 50% a week of more virus cases. And now we're at 35% in a week. It's not worse. Let's be positive. That's not worse than 50% a week. If we are on a path, and you can't obviously tell from a week, but if we're on a path of going from 50 to 35 to 20, so next week, if we have only 1 million cases, that'd be 20% more than 850,000. So if we have only 1 million cases next week, we're actually doing well. Although the problem is next week, 1 million cases is going to freak people out. Right? So we're going to get, so on the plus side, $500 billion worth of fuel. On the negative side, we're not getting over the 50-day moving average, which is rapidly declining. We're not getting over our must hold level. And if we're getting rejected here, the path of least resistance takes us down to 2,700, which has been weak support. And at the same time, and this is what you do with a graph. You have to think about how the candles are going to form and how they're going to look. So if we look rejected at the 50-day moving average on stimulus, that's a sign of weakness. The next bit of news we're going to hear is we know for a fact that next Wednesday, 5 sessions from now, 5 sessions from now, we're going to be in this range. There's not going to be another stimulus from the government, right? We're not going to be able to appreciably show any improvement in the virus. We're doing stupid things politically and sending people out and whatever. There's not going to be a cure. You have to think ahead of what's going to be moving the market in the next few days. And and given that, and what we know for sure is going to happen is next week we're going to cross the 1 million case mark. 1 million infections in the US. Hopefully, and that's if we slow down to 20%, it'll take until Wednesday. If we don't slow down, it'll happen much sooner. It could happen this weekend. In fact, and also we're doing more testing. More testing is good, but more testing means more cases. Like more money, more problems, right? It's more testing, more cases. So as California found out, And this is probably another reason Trump does not want to test. Because if you test and you find out that actually 15 million people in the United States, 4% have the virus, it's kind of hard to say that you did a fantastic job of keeping the spread under control. So better off not to test. I could even see the logic of that. I could even see the logic of sitting in a cabinet meeting and saying, well, Mr. President, if you test everybody, we think the infection rate may be 4%, and that's going to be 15 million infections. And we did a focus study with a few people from Minnesota and Michigan and whatever, some of your voters, and they said, oh my God, the world's ending. We don't think that plays well for the elections. So, you know, and then the president says, well, what do I do? And then the guy's going to be like, well, I think we need to put off testing as long as possible so that we can ease people into the idea that there are many, many more cases. In fact, we'll try to make a spin to show that Donald Trump thinks there's many, many underreported cases, and we'll blame China for underreporting their cases, and we'll blame the WHO for saying this and that. And now Donald Trump is going to tweet out, I have a suspicion there are many more infected people in the US than they are letting us know. As if he's not the one that's not letting them know. And then you demand more testing, as if it's like as if you were not the one stopping the testing in the first place, or not stepping up the testing, and you demand more testing, because this is how reality works now. You can actually just change reality by having Trump follow a series of events. And if I were advising Donald Trump, and if I had no freaking morals whatsoever, that is what I would advise. Drag it out. Make it confusing. Blame China, blame the WHO, blame the governors, blame the immigrants. Just keep throwing blame around, and then you come out as the only rational guy who says, I think there's a lot more viruses than we're counting. And then work with your buddy Mike Pence to test as many people as possible to prove to the media that you knew it, that this is much worse than you thought. And why didn't anybody listen to you sooner? There you go. Problem solved, right? So it's not that hard to see how this is going to work. But meanwhile, what's the short run? The short run is we are going to cross 1 million cases. That's like basically a fact that's going to happen in the next 7 days between now and the next webinar. That's a big number. It's going to freak people out. It's going to make the headlines of the paper. It's going to make the headlines of this and that. It's going to be very hard for Fauci or Trump to sit there and say, oh, well, we have things under control now with 1 million cases. They're going to have a really hard time spinning this for the next few days. That's going to be a downer for the market. So therefore, I want hedges. Okay, so now we're back to that premise. I mean, honestly, I'm really so close to saying I don't even want. I would rather go. I would almost see. I can't decide. But I was going to say I would rather. Then I'm going to say I would almost rather. And I'm thinking, no, I think I would rather. I think I would rather cash the long-term portfolio in. We are blessed to have the same amount of money that we started with in this portfolio after 5 months of screwing around with it, or 6 months of screwing around with it. We have the same amount, but fortunately in the long term, in the short-term portfolio, we have a ton of money. We made a huge profit there. Why did we make a huge profit in the short-term portfolio? Because it's bearish. That's not complicated. We started this portfolio in January, and it's a bearish portfolio. It made a freaking fortune. You couldn't have picked a better time to be bearish. We got there. We were bearish in a record high market. All right. But if I cash the long-term portfolio, I'm not going to keep all these hedges on blah, blah, blah. I'm going to keep some hedges, but I'm going to play short, but I'm not going to completely hedge everything. There's no point. There's nothing to protect. What we'd be protecting is the it's $1 million of cash. If we cash that, if we cash the long-term portfolio, we cash this portfolio, we have $1 million. We started with $600,000. That's it. Mission accomplished. Wait until the market settles. Do what Buffett is doing. What's Warren Buffett doing? Nothing. He's sitting on a pile of cash. Yes, he has his companies, but that's what his cash is for. His cash is to protect his companies. And so I said that about the long-term portfolio too. Our cash is to protect our own positions. We're not running into new positions, and we're not changing. We're not adjusting positions. We don't have to adjust. We're just watching and waiting and making sure that we have enough firepower to fix things if things get worse. But we're on a cusp, and I said this 2 weeks ago, that the next 2 weeks are going to determine where we are. So we looked at earnings, which have not been that terrible, but they only account for the first, March started off not so bad because we weren't freaked out yet about the virus. And although we should have been, obviously, but we weren't. And March didn't start out so bad. It was really the last 2 weeks of March when everything died. But that means the other 10 weeks of the quarter were fine. So you're not getting an accurate reflection from the current earnings reports of how bad things are in the second quarter. Second quarter, we're starting off terrible, and it's gone on for a month already. So the second quarter is twice as bad as the first quarter already. An entire month is shot versus 2 weeks being shot at the end of the first quarter. Now, we were at a full-blown running start, record highs, blah, 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 right? And now we're getting started from coming off our hospital bed and getting back out into the world. So even if the virus ended tomorrow, which it's not, obviously, it's not going to end on May 1st. It's not going to end on May 15th. May 15th is the earliest possible of any sort of visibility that we're going to be able to get back to something that even resembles normal. And as I said, though, that's way too soon, probably. But even if we do that, then you're into the middle of the second quarter, and you're off to a dead slow start. You have to get up to speed. So the second quarter is the real disaster, not the first quarter. And people are looking at the second quarter and say, people looking at Q1 and saying, "Oh, that's not so bad." Like Chipotle. I've never seen anything like this. What does this chart say to you? If I'm the head of Chipotle, they're up $100 today. What am I saying to my shareholders? Did he say, "Gosh, I hope this virus lasts forever. It's the greatest thing that ever happened to our company. We're at record highs because of the virus"? But that makes no sense. Yes, their online deliveries are up 100%. But online deliveries were only 10% of their business. Their restaurant business is 0%. Zero. No, so if 90% of your business goes to 0 and 10% of your business goes to 20, how are you doing better? How are you doing well enough to justify all-time highs, 85, 100 times earnings multiples right now? Where is the logic of this stuff? So before I forget, though, back to the short-term portfolio. I want to hedge then. If I have positions, even if I'm saying, "Oh my God, I have Chipotle, it's doing great." I don't think we do, though. That's too funny. Even if you have positions like that, you have to be realistic and say, well, what if this falls apart? What if these people are insane? What if it really doesn't make sense to have this takeoff like that? And that goes for all of your long-term portfolio positions. Should they really be as high as they are? Are we reflecting the actual possible damages that can be done to these companies? And to the extent that we don't think they are. So anyway, it's very simple to adjust these hedges, because you look at SDS, and we have the January 20 calls. So we go to SDS. SDS. And we get the January 20 calls, January 20. And they are $7.50. Now, how much are the 15 calls? Well, the bid ask is 10.11 basically. So they're probably about 10.50. So it would cost us $3 to roll those lower $5. That would put us $5 more in the money for $3. But that's not really worth it though, because it's at 25 and the spread, the 20/40 spread is only $4. So if I'm going to spend $3, I'm better off buying. If I was going to spend $3 to roll these lower, and we're already in the money, I'm better off taking the $3 and buying 75% more longs. That would then put me 75 times $5 in the money, right? So I'm doing better already. I might have spent, I spent $3, the same $3. So I'm going to spend the same $30,000 either way, but instead I'm going to spend $30,000 on 75 more shares. But that 75 is $5 more in the money. All right, so then we take 7,500 times 5. So I'm $37,500 in the money. So my $30,000 bought me $7,500 in the money SDS calls and the short 40s, which are miles out of the money, so I don't have to worry about them. Or I could actually, instead of doing that, I could probably spend less money and sell some 35s on the new batch. So in other words, I could buy 100 more 20s and sell some 35s. Oh, I like that idea. What's that? Because we already decided that we don't think it's going to go to 40 anyway. So if I sell the 35 calls, there you go, $4 instead of the 40 calls, which are, you know what? For the extra money, I don't think it's worth it. It's because these are 330, 340 anyway, and these are only $4. So I don't know, for 70 cents, I'm not sure if I would bother. But you get the idea. So that's what we do. We roll our positions down. We have the June SDS, but I'm not really that worried about an immediate pullback. I'm more worried about a long-term pullback for our long-term positions. So maybe I'd rather have these 10s, and these 10s are $3 in the money, and they cost $6, so they're 50% in the money. And we already said that if the NASDAQ drops 20%, we're going to be looking at about $21. So what if I sell some? What if I sell some calls in 2022? Oh no! In fact, no. What if I do this? So look at these January 35s for $3. See, so I can buy these. I can buy more for $6 and sell them for $3. So let's say we buy, to round it up to 200, I buy 95 more of these calls for $6, and I sell those calls for $3. The same amount, 95 more, and then I would have 200 longs and what do we say, 95 and 160 shorts. Ooh, I like that. Yeah, we're gonna do that. So now I've got enough. So I've spent net $30,000 ish on the spread, and I've gotten more than $30,000 in the money of protection. Boom, done. And what's my upside? My upside at 22 would be $12. At 21 would be $11. So I could get back from my net $3 investment, I can get back $8. So I'm buying $80,000 more of protection. But the key is I'm not selling any puts. I'm not taking on any margin risk at all. I'm just paying $30,000, and I'm going to get back $100,000 or more on a 20% drop in the NASDAQ. So if I'm going to keep but here's still my decision. Am I going to keep my long-term portfolio positions? And now I have to make the calculation in the long-term portfolio and say, okay, so if I'm going to keep these positions, it's not free to keep them because I'm not adequately hedged. We only have 200,000 worth of hedges, and this thing's going to drop $400,000 if things go bad. So I'm going to add at least $30,000 worth of protection to get another $100,000 worth of protection. So therefore, it cost me $30,000 not to close this portfolio. Got to assume I'm going to lose the $30,000, right? So it's going to cost me $30,000 not to close the long-term portfolio. That's why, by the way, I took, let's go to the review. So on the review from Friday of the long-term portfolio, where are we? Oh, this is it. All right. There's 3 parts. So in the long-term portfolio, which was 542, by the way, at the time, so we were losing a bit of ground, but that's normal because things fluctuate. So what do we do? ADP, I don't know when jobs are going to return. Let's kill it. Boeing, take the money and run. Caterpillar, up 50% in a month, kill it. You know, it's not, if I'm up 50% in a month, I gotta wait 2 years for the other 50%, and I have risk. If there was no risk at all, that's different. But if there's any risk at all, why risk it? Energy transfer, that was a roll that's not off the table. Six Flags, it's become a long shot, and let's see what happened. See if I was right. Not that 2 days proves I'm right, but yeah, see, it's flattening. The thing is, yeah, I went by Disney because when Disney said Disney laid off 100,000 workers. So if Disney laid off 100,000 workers, Six Flags is no different than Disney. They haven't announced anything yet, but if Disney's saying they're not laying off 100,000 workers because they think they're going to need everybody in June, right? That makes no sense. So they're writing off May, and they're probably writing off June, and July is iffy. So and then there goes your summer. Amazon, that was short puts. We had these two. I figured out what happened because it was 2 short puts. It was treating them like some kind of a spread or a pair, but it's not. They were 2 short puts, but it didn't put them up at where the other puts are. But anyway, I was like, we were up, 60% on both of these short puts. So I'm like, forget it, take the money, because it's possible something goes wrong, and then we lose all the money we gain. Why would we risk that? It doesn't make any sense. And again, if we cash it out, we don't have to hedge it. It makes our hedges more effective. It makes it cheaper. Discover, we bought back the short puts to reduce the risk there. Gilead, we doubled down. That's different. We love that trade. Oh, there's poor LB. What did I say about LB? I can't believe how much they want for those 22.50. Based on that alone, we can't get out of the position, as I would never pay that to close them. It's a $75,000 spread at 22.50 and currently net 14,700. So 60,000 upside potential, but I don't think we get to 22.50 very easily. Still, the risk reward makes this good for any trade. Oh my God, famous last words, right? So apparently what's going on with LB, they were supposed to be getting $500 and something million for selling half of Victoria's Secret. That money was perfect because it came right during the downturn, and it allowed them, in theory, was allowing them to basically hold on, get through this, and move forward, and hopefully take advantage with the cash they have to do some other opportunities. Well, now the guys who are going to give them the money, a private equity firm, says, you know what, we changed our minds. We're not going to give you $500,000 anymore. That's not good. All right, so that means LB, first of all, is going to need money because they thought they had money. They made no arrangements to get a loan or to do anything. They're not getting through this. Obviously, they're not going to get through this thing unscathed. Their stores are closed like anyone else's, and that's devastating. And now the implied value of Victoria's Secret and anything else is half of what it was. There's going to be a huge lawsuit about this because obviously now LB's saying, well, wait a minute. Now we couldn't sell. You guys said you were buying it. Now you're not buying it. But now we are in a situation where it's worth half of what it was. and we turned down other potential buyers. It's a real disaster. Let's see what it says. Purporting to terminate the pending sale. L Brands will vigorously defend the lawsuit and pursue legal remedies. Yeah, this will drag on. L Brands intends to continue working towards closing transactions contemplated by the transaction agreement. They believe Singapore's purported termination of transaction agreement. L Brands will say the vigorously. Yeah, they're really past a point of no return on the transaction, but that's that's up to lawyers and judges now. I mean, nothing is for sure in these kind of things. But that is crazy. So anyway, so things obviously turned seriously worse for Victoria's Secret. Anyway, all right. Well, getting back to the LTP though. What else do we have? TD. I'm worried about them because of the oil, right? So we knew that was brewing on Friday. So we decided to kill the TD spread because it could be a victim of the oil. Toll Brothers, also the builders I didn't like the environment of Toll Brothers, so we killed that. WBA we liked, so we actually fixed it. Well, we actually added to it a little bit. And Exxon, though, surprisingly, we kept it, but we got rid of the short puts. Oh no, wait, no, I'm sorry, no. We took the money on the spread and we left the short puts because the short puts are way down at 27.20. But we took the money on the bull call spread because I wasn't sure they're going to keep going higher. And we got a nice payout, so it wasn't worth it. So there you go. So you see, so in this portfolio, which was, that's not the long-term portfolio. It was 542 at the time. I decided to cash out a bunch of positions. So we had 433 cash, 542 in value. And now the long-term portfolio has 426 cash and 500 in value. So we didn't change much. But we have less positions. We removed some volatile positions and hopefully it won't get too wounded. But now we're down to 506 here from 544. And the short-term portfolio has also, well, today the short-term portfolio is also taking a hit. So it's at 532. So now we're at like 540 and we had topped out around, it barely changed since Friday, but overall, I think last week at one point we were at 1.1 million with the combined portfolios. So that's so far the best we can do. And you just got to keep benchmarking things and seeing where you're going and which way it's going. But now I'm saying, so here's the problem. So if I want to really protect the long-term portfolio and keep all those positions, I have to say to myself, do I really want to spend $30,000 more to protect it? And then you've got to go back, look at the long-term portfolio and say to yourself, well, okay, now let's see how much money we're going to make if it goes well. Because I know I got to spend $30,000 to keep these positions, so are they worth keeping? Short puts. I already eliminated ones we seem worried about, so I don't think we are. Apple, 274, 150, not a problem. 274, 230, a little more of a problem. 191, 110, not a problem. Energy Transfer, 6. Wait, see, okay, 6. This is. Oh, I see. It's not really about the strike all the time. In this case, it's an $8 put we sold for 420, so it's 380. So the net 380 to $6. We don't think that's a problem. We left it. Hanes brand, $8 put for 325 bucks. It's way over. No, not worried. IBM, 120, 180. See, when it's that much higher, I'm not bothering about the net. Intel, 60.30, not a problem. Coffee, 35.30, not a problem. Lockheed Martin, 378, 160, not a problem. 96.60, not a problem. 155, 100, not a problem. 150, 75, not a problem. 18.15, not a problem with Tenant. Because it's Tenant, I'm not worried. Exxon, 41.27. I'm actually a little bit worried about that one, frankly, but not enough to take it off. I just can't. I don't believe in that. They have because they have refining operations and chemical operations and other things, I think that they're gonna get through this okay. So boom. Oh, so now I say, okay, well, none of that's a problem. How much am I being dinged for? It's not how much money the puts was sold for. It's how much money is remaining short that I think I'm going to collect. So it's 13, 17, 20, 20, 30, 35, and 7, 8 is 43, and 11, 44, 54, 60, and another 20 is 80,000. So here's 80,000 we're going to collect if things don't go lower. All that has to happen for us to make this 80,000 is that these stocks don't go lower than they are now. DFS. So Discover. It's at 34. It's a 25-40 spread. Not too worried about it. Plains All American. I can't even believe how low they are now. I am dumbfounded by that. Anyway, our target is only 5. You know, we're out of these things at 5, and we sold the $8 put, so we'll be back in at 8. But we're out of this set at 5, and we're going to collect $40,000, and it's currently net $44,000. That's interesting. So it's, wait a minute. Oh no, I'm sorry. We have more, we only sold half. We only have a half cover. Oh, that's weird. I didn't know that. Ooh, that's a mistake. Huh. You guys gotta tell me when you see these things. Oh, okay, they shot. I was right though. Ah, I was right not to cover it all up. All right, well, we definitely want to cover that though. I mean, we're going to be thrilled to get out of this thing with a little bit of a profit. If they keep paying their dividend, that's all we care about. It wasn't my intention to be such a big gamble on that. But I think the point was that when we did the double down, we thought it was completely ridiculous, the price. Anyway, Alaska Airlines, that's tricky. I'm not sure I like that much now. I don't like the bailout package for the airlines. I don't like the way it goes. A lot of it has to be paid back. So we'll see. Broadcom, they just posted great numbers and everything. They're up $11 today. Berkshire Hathaway, if you're going to have any stock, it's going to be them. Comcast, fine. Cisco, fine. Freeport, I don't know why I like Freeport. Oh, I know why, because I think there's going to be infrastructure spending. Gilead, obviously. GM, probably not going to die. IMAX, timing wise, I don't think this is realistic. We're not going to make the money back in September. But we're looking to roll that along and stick with it. That was the logic there. Leibu Pharmacy, that's a home run, not pharmacy, but biotechs. LB. See now, interestingly, we're not actually down on LB. Even with this ridiculous drop, we're still up quite a bit on it. It's an adjusted position, but you know, should we bail is the question. That's going to be a tricky question. This is not a bad position because we're in the 750s. The 2250 calls though, those are unnecessary. But it goes back to the same thing. Why would I pay that kind of money for the 2250s? But I think on the whole, I don't know. It's hard. I'm gonna have to think about that more. Macy's iffy, but I like it. If you're gonna gamble on something, I want to gamble on that. Middleby, I think, is ridiculously underpriced. MJ's the ETF. We're in that to make money by selling calls and stuff, but we haven't sold any right now. Altria, no problem. Restoration Hardware is one of my favorites. SKT, nobody likes them, but I like them. SunPower, love them. Textron, fine. Vail, again, materials, we think that'll come. We think there's infrastructure. Viacom, I think I said we could sell the whole portfolio and just buy this spread. Okay. This spread is 55,000 minus 30 minus 21, or really, that's more like 22, more like 22. So about 52. It's maybe like a $3,000 net spread right now, and it pays. It's not even fully. Wait, did I do that right? Yeah. So it's about a $3,000 net spread, and it's a 515 spread, so it's a $50,000 spread that you can buy for $3,000 right now. And what does the spread say? That Viacom will be over $17, because that'll make the puts expire worthless. Viacom be over $17 in 2 years. And if that happens, you turn $3,000 into $50,000, $47,000 profit, 1,500% or whatever the hell it is in profit. Now, honestly, I don't think I could actually justify, if you pushed it to me, I don't know that I can justify doing anything else with your money other than this spread. Okay, other than the logic of diversifying your portfolio and saying, well, you shouldn't put all your eggs in one basket, blah, 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 blah. Freaking Viacom, it's CBS, it's a broadcasting company when everybody is forced to stay at home and watch broadcasts. So thing number one, there's one thing about it. Second of all, they're a huge money-making cash machine of a company. And again, bailout money and everything else, stimulus. It's like they're able to borrow money, move money, do all kinds of things. We'll see on earnings, but I would hate for it to be too late. So in the very least, since it pays 15 times your money back, if you have a place for risk in your portfolio, and I'm not saying take on new risk, I'm saying take a look at the risk you already have and consider this may be a better candidate for your risk money than whatever it is you have your money in. Okay, this is net $3,000. You are obligated to own Viacom at 17. So maybe you want to sell a lower put and pay a little bit more cash up front. But either way, it's a huge home run of a play if Viacom just holds on to where it is now at the bottom of a crisis. I mean, I don't know what I can say to you. It's so weird when I have to explain things like this. It's like when Apple was $75, and that was before the split. So Apple was basically $10 a share before the split, or $11 a share back in 2008 and 2009. Just like this, looked just like that, and it's like a religion, though. It's like people either believe it or they don't, and the people who believe it can't even explain to the people who don't, because it's just like, because what the frick? It's like, because how could you even ask me the question, is that worth $15 a share? How do we even have a discussion on whether or not Viacom which just merged with CBS, $27 billion in revenue as a combined company, $3 billion in profits, $3 billion per year. And it's not like this is something getting lucky. This is just the merged companies caused a $3 billion annual profit. They were two different companies, now they're one company. Buy it for $10.5 billion. Okay, so we take our handy dandy calculator, we take 3 divided by 10.5, 28%, 28.5% return on your money as in what they call the internal rate of return, IRR. So in other words, they're not giving it out as dividend, they're not giving it all back to you, obviously, but the company, as if you bought the company for $10 billion, and if I had $10 billion, I'd buy the company. If I were Warren Buffett, I would buy the company, no question about it. Because for your $10.5 billion next year, they're going to make 28% of your money back. And that's without any growth, without expecting any great gangbuster things to happen. They're just going to make $10 billion. Hopefully down the road, they'll be able to. They had some great plans to expand and grow and do things. It all got put on hold right now, but I think they'll get back to it. They're a logical corporation. They're one of the major broadcast networks in the United States. They have movies, films, production companies. MTV is theirs. Comedy Central is theirs. These are worldwide brands. They're standard on like every single cable system in the world. They're known names. I guess VH1 is them too. I mean, there's a lot of things that are theirs. They own all the Star Treks. That's another reason I like them. And CBS All Access is another online service, but it's actually worth subscribing. If you're a Trekkie, it's worth subscribing to. And there's a lot of those people out there because they have two good shows on there. They have Star Trek Discovery and Picard. Now they have the Picard show, and they're developing more. So there'll be great reasons to subscribe to what's effectively going to be the de facto Star Trek network. And I'm sure they'll probably develop other science fiction brands, but it doesn't matter what they do. They'll do stuff. They're a TV company. Okay, it's like in 1960. You know, they had Candid Camera, and they had the Match Game and To Tell the Truth or whatever. It's like, yeah, they you know, you would at the time you would have said, well, they do game shows and they'll think of some other stuff. Yeah, that's what they do. They're a broadcast company. That's their job. They think of shows and they put them on. Oh, that reminds me of something else. Anyway, so all right, let's finish this first. That reminds me. Let me get back to Netflix. So Viacom and Walgreens Boots. Again, how undervalued can you be? This undervalued. Okay, so I guess if I was going to put all my money into Viacom, I'd put half of my money into. I'd borrow all my money to put it into this one. They're at 43. We have the $40 calls and the $55 calls. We sold the $45 puts. We sold the $52.50 calls for short-term gains to make some money. The net of this spread, 35 minus 25, about $10,000. And if this goes well, it's a 15 times 40, $60,000 spread. So here's $10,000 that turns into 60 if all goes well on this one. So I don't know. I mean, to me, that's pretty good. I consider that a good trade. And here's what Walgreens looks like. And again, it's another company that unfortunately was in the middle of a merger and crap happened. Walgreens merged with Boots. Boots is a huge British drugstore chain. So they've been down, but this is bullshit, and this is just ridiculous. And especially in a pandemic, it's like I think people are going to Walgreens. I think people are getting their drugs. And I also by the way, I don't think people are not getting their prescriptions just because there's a pandemic on it. That's one thing people are still doing. In fact, my mom was just saying that she had to go to Walgreens. She hasn't left her house in like a month, but she's going to go to Walgreens to get it because the prescription ran out. I said to her, I said, of all the places you're going to go, Walgreens, where all the sick people are, that's where you're going to go. So she's going to drive it. So that's crazy. Oh, Netflix. Okay. Hang on. Let's see if we have any questions first. I got to remember to get back to Netflix, though. Ooh, look at questions piling up. All right. That's not so bad. I can get to those. All right. So here's my theory on Netflix. They didn't expect this to happen. See, you binge watch a show. You know, it doesn't matter. Let's say it's Game of Thrones. It has 5 seasons and 10 shows a season, 50 shows, so 50 hours of broadcast. Let's say a regular show maybe has 20-something episodes, so maybe you'll watch 100 hours of another great show, right? So Netflix assumes in their model that you're going to watch 4 or 5 hours of TV a day, and it'll take you 5 years to get through their content. And now I don't mean all their content. I mean the content you actually want to watch. And therefore, they add content at a rate of 20% a year. And again, I'm talking about the content you want to watch. Okay, so in other words, every user has their own bubble. This is Netflix's pride and joy. They're like, every user has their own section of shows that they like to watch. And the way Netflix does their model is they figure out for each viewer, there's a lot of narrowcasting in Netflix. So in other words, for almost everybody, they have a show that you love. Like for every kind of taste and whatever, they have something you're gonna love on Netflix. Then they've got stuff you're gonna like, that you're gonna stay hooked with, and you'll watch that too. Why? Because I already have the subscription. So therefore, I love this, I love that, and these guys are okay, and they're on my watch list on Netflix. You know, hopefully I'm talking to people on Netflix, which I assume is pretty much everybody. So their business model is to hook you in with something that really, really, really appeals to you narrowly. But then they've got their little bubbles of like, if you like this, you'll probably like that. And if you like this, you like that. And it gets you to watch other shows and so on and so forth. So in general, though, you've got a sort of bunch of Netflix shows that you want to watch, and you recommend shows to your friends and blah, blah, blah. In fact, my daughter, I recommended to her, I said, I forget what it was. She liked something, and I said, "Oh, if you like that, you'll probably like Dexter," because she liked something that had to do with like a murderer that was a sympathetic character. And I said, "Oh, if you like that, you'll probably like Dexter." Dexter was a really cool series you probably never heard of, and she loved it. She thought it was great, but she watched the whole thing already. She watched the whole 5-year, 6-year run of Dexter in a week or two. And this is not what Netflix counted on. Netflix expects you to be tied up for months watching Dexter, and then you get to another show, and you might pick a couple you don't like, but then you find something you do like, and you watch that as a binge, and you watch it for a few months, and then maybe you drift, and then you find something else. But their model is that they can usually catch you with something that will keep you there and make you feel like Netflix is essential to your life, right? But what happens when you use up 5 years worth of watching in 2 months? All right, I've already been talking to people about it who said, I've done Netflix, I'm done with it, there's nothing left on there that I want. They aren't, and here's the other problem, there's now a production gap, so they aren't putting new shows out because nobody's producing those shows. There's nothing in production right now. So how long can this go on? So the combination of the longer that we stay inside watching Netflix and the longer that there's a shutdown of TV production, there's no new shows for them to put on, they're going to exhaust their consumer base. And what's going to happen when people are allowed outside and they're still on a tight budget and they no longer have to sit there? And can you imagine how many people are going to say, I don't want to watch another freaking show on Netflix? You've been sitting on a couch for 2 months watching Netflix. When they let you out, it's like getting out of prison. It's like you don't want another bowl of Spam. That's not interesting to you anymore. You'd like to move past that point in your life. It's going to get a very negative connotation. So I think, interestingly, they may become undone by this virus. They had a big boost in subscribers and all that, but I think that what they're doing, unfortunately for them, is exhausting the content way, way ahead of schedule, and they're just not prepared for that. That's not the way their model works. So that is my theory. It's too scary to short, but it's very tempting. I was already a Netflix bear beforehand, but unfortunately we got out of that position. I was short Netflix here when it got close to 400. We shorted them. We took the money and ran down when they had a nice dip. Now they're at 440. I think this is really undeserved. But it's not a short-term premise though. I just think in the long term, you're going to see after this virus lets out, I think they're going to have a very bad quarter. That's my prediction. When the virus lets out, they're going to suddenly get hit with a wave of cancellations of people who don't feel like they need Netflix anymore. It's not a necessary expense. So we'll see. And don't forget, we're effectively rich. If you're listening to me and you've got time to diddle around with stocks and so on and so forth, you're richer than most people. So you don't think that you're like, oh, I wouldn't cancel Netflix because it's $9 a month. But other people don't think that way. They look at their bills and they see recurring bills and they just look at like, I can't afford that, I can't afford that, I can't afford that. It's not a necessity, it's a luxury, and there's the majority of people in the world know that. All right, so where are we? Questions? So JC said time to bail out of LB. I can't decide. I mean, it's tough. I guess I wouldn't do it if it was stopping me from doing something else. But for in the long-term portfolio, it's like unless I have several better ideas, I don't see the point in getting out of it right now. Robin says, Phil, your thoughts on an initial buy-in spread on natural gas pipeline OKE? It's a corporation, not an LP. It goes ex-dividend tomorrow. Oh, that's nice, 93 cents a quarter. And how much are they? Wow, 27 bucks. That's pretty damn good. So they're going to pay a 90-cent dividend. Will the oil shutdown have a major effect on their gas flow? I don't know. I don't know this company, so I don't really have any real thoughts on them. Looking for long-term dividend pays with good yield. You don't know what the situation is. What if they cut their dividend? I mean, obviously somebody's anticipating they're going to cut their dividend, or they said something. I mean, they must have said something here. This is not natural. I mean, they got dumped. So you're looking at them after they got dumped, but you don't know why they got dumped. And honestly, ask me in chat. I'd be happy to go over it. But I don't know why they got dumped. I don't know what happened to them in this situation. If you're going to play the stock, OKE, obviously, if you're going for the dividend, you got to pay the stock. And they go out to 2022. That's good though. So if you can sell the 1750 calls for 1250, that's 2950, right? I would do that. I would buy the stock and sell the 1750 calls for 1250, and that's going to net you in for $10 basically. Okay, so you're in for $10. What does that do? That makes your dividend payment 10% per quarter. But meanwhile, if the stock drops all the way down to 17, you're fine. You could care less. If they cut the dividend, you might not want the thing anymore. But the point is, you're protected all the way down to 17, and you're in for net 10, and you're collecting your dividend, which is $4, which is 40%. In fact, frankly, I'll take a look at this one if someone reminds me, because why not, right? Where's the harm? If they keep paying that dividend out, this is a super duper home run winner. If they don't pay out the dividend, still might be interesting, and if it drops down to 17, you still might not care, but it doesn't matter because you're still in for net 10, even if it drops to 17, because you got paid $12.50 for the 17 calls. So it doesn't hurt you to go to 17. You're in for, I'm sorry, where did I get that number from? 15. I'm sorry, 15. You're in net 15, not net 10. I don't know where I got that. You sell these for $12.50, your net is $15. So if they drop all the way to 15, let's put it that way, you're fine. You're even. And I'm sorry, it's not 10%. It's like whatever 80 cents is out of 15. What is that? So if it's 1 divided by 15, 6.5% per quarter. So you're collecting 6.5% per quarter if they're paying 95 cents a quarter, or 93. So you're collecting about 6%, let's say, per quarter on the $15. So you're only in for 15. Now, even if it dropped all the way to 750 and you're in at 15, you could just buy some more at 750, double down to 750. Now you spent 22, which is still less than it was now. And you'd be in for an average of, whatever, 12.50 or 10 or whatever it works out to. And again, it goes back, and then you could sell more calls to cover again, because obviously this call guy lost all his money. So you would then sell more calls, lower the basis even further. So as long as you are comfortable with that kind of risk, as long as you're comfortable with having to double down at a much lower price and whatever, then you just say, okay, I'll try to ride this out, this thing. Again, I haven't researched it. I don't know anything about the company, but I'm just saying, if you feel comfortable and you think that's a good deal and you don't think they're going to be impacted by the shutdown too much, that's the way to play it. I would still play conservatively, but at least that gives you a wide margin of error if you're coming in now. Potter says, how do you calculate what a 20% index drop would do to your long-term portfolio? You don't calculate it. Your broker might have an analysis program that lets you do that. Some do and some don't. But honestly, I watch what happens to my portfolio on a 5% update, on a 2% update, what happens to my portfolio on a 2% down day. I make notes of it, and if I see, and obviously every time you change the mix, you got to obviously start taking track again. But when I see the portfolio on a 2% down day loses $50,000, then I say, okay, I lost $50,000 on a 2% drop. So if I have a 20% drop, I'm going to lose $500,000. You know, that's what you got to look at. So obviously it's not $50,000, but you have to observe what you're losing and think about where you're going to be in your positions. Now, to some extent, though, you have to also be aware that some of the losses that you're seeing are being caused by a higher VIX. And even if we go down, 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 as long as we stay down, once it flattens out, the VIX still drops, and you don't appear to lose as much money. So we saw that in the last drop, that we had some alarming losses a couple of days, but that was because the VIX spiked higher. But then once the VIX flattened out, the losses diminished, even though the market hadn't actually gone up. So you have to calculate it by observation. It's a scientific, it's basically a science game. You have to observe and write down, and then watch the trends, and then you can kind of extrapolate what's going to happen. And then as you watch your model, you'll see that if it's conforming to your model or not, and you'll know whether or not you should make adjustments. Phil, your thoughts on NG, where the June 9 cargoes have been canceled? Would you short NG even though shale? No, I wouldn't touch it. It's like oil. It's too stupid. Okay, I believe long-term natural gas will be more expensive because there will be less shale production, because there's going to be a huge demand still for exports of liquefied natural gas. There'll be less shale production, there'll be less natural gas. But as a short-term thing, you got to be insane to play this market. You don't know what the hell is going to happen. I mean, now they're declaring, I said that the other day, I said they're going to declare force majeure, and that's what's starting to happen. They're declaring force majeure on the contracts. That's a disaster. I'd stay away. Honestly, it's not worth the risk. Randy says McConnell favors allowing states to declare bankruptcy. Well, that's too bad for their debt holders, I guess. That's crazy. You know what that's going to cause, though? The net effect of that is that how are they going to borrow money cheaply again? I mean, I guess the Fed will have to give them money, but how are the states going to borrow money if they can be allowed to default like that? Then the bond rates for the states is going to go through the roof, which again is something that the Republicans like, because they're the ones that they've got the money. Their donors have the money, and they're lending to these states. They would love to have the states borrow money at 10% and 15% from now on. That's a huge win for rich people. You get your tax-free municipal bonds that pay you 10, 12% interest because the states no longer have any kind of credit that anybody's willing to lend them money cheaply anymore. Fantastic. Can't wait. So that's why it's such a good plan to let the states go broke. Mike says, I have to imagine the S&P doesn't bust through its 50-day moving average on the first trip. That'll pull back. Let's say you agree with that thesis. Do you stay balanced between the LTP, STP, or press the hedges, maybe some long calls? No, that's what I was just saying. I hope I was able to clarify that better. I was saying I'm inclined to press our hedges, and the way I'm inclined to do it, we decided, is I'm going to add 100 basically of those SQQ spreads, of the long-term ones, not the short-term ones, the long-term ones, because frankly, if we start going down again, I will pull the plug on the long-term portfolio. I'm not, you know, if we go down, and again, if the virus picks up, it's gone. That's why we track it every week. 50%, and you can do it on this chart. Okay, so you don't need me. You can make your own Excel spreadsheet. You can set this thing up. You can do it properly. It's very simple, though. This is daily. You click on the United States, This is a daily chart of the United States. Viruses by day. 421, 800. So 414. Oh, wait, is that 421? Oh, that's not even today. That's why it's less. All right, so 421, 823, 414, 607. So that's 215. 14, 47, 400. So that's plus 200. Now, the same amount of additional cases, basically, but here it was 50% to the next month, and then it was cut down to 35% because you had a bigger number that you were coming from. What was that, 47? So then we go back to 331 was 188,000 cases, and I'm sorry, 47 was 400. So it was 100%, 100%, 50%, 35%. That's a good trend. It's a horrifying number of cases, but it's a good trend. On a weekly basis, we're slowing the growth of the virus. Now, again, back to me bitching and screaming this week, because I'm happy there's a good trend, but that good trend is caused by the policies that we are currently pursuing. So on Monday, this was what I was worried about. On Friday, what did I say on Friday? No, that's not Friday. Oh yeah, on Friday I felt that we were starting to ignore the dangers of the virus. I think we're at a critical point here where 600,000 cases. By the way, that is the 17th. Today's the 22nd. We had 641,000 on the 17th. So, you know, it goes up and down because we have 200,000 more now. So if you look at it that way, that's only 5 days. Either way. So the bottom line is, I said, look, we have 641,000 cases now, and we're talking about going back to work. And the market was going up because of that idiocy. Then on Monday, didn't get better over the weekend, it got worse because over the weekend, these idiots are out on the street. I live right here. This is my town. This is my block. This is a pizza place I eat at where these guys are standing. So this is me basically. I'm like, I was across the street over here. It's stunning. You just look outside and you see these people, and they're all bunched up together, and they don't have masks on, and there's supposed signs all over the place behind them say masks, must have masks to go to this restaurant, blah blah blah. But they're standing right in front of the sidewalk, in front of all these places, and they you know, the incomprehensible bullshit that they're spouting, and the idiot, he doesn't have a good picture of it. There's so many stupid signs like give me coronavirus, give me liberty or give me the coronavirus, something like that. I was just like, I mean, I am blown away. And meanwhile, though, you see the same signs all over the country. So you know it's the same group, you know it's the same people who are pushing these guys. It's obviously not these guys, these idiots from Florida aren't coordinating with the idiots in Montana, but it's the same. They do coordinate in that they all watch the same news and read the same websites and get the same emails, and those are the people who get rallied up. That's how these things work. You know, these networks of various groups and influencers, including Russian hackers and things like that, will stir up these people and get them outside and get them to rally to their cause, and then they coordinate. But it's even better when you can coordinate it with the President of the United States, who starts off, liberate Virginia, save your Second Amendment. It's under siege. What? But that was not about the Second Amendment, and I don't know how that got brought into it, but then now you see all these rallies where people are bringing their guns to these rallies too. So there's nothing better than rabid Trump fans and guns. So we're like, but this is the Liberate Michigan Liberate. So he's calling out these liberators. That's what these guys are. They're the Liberate groups. And they want the states to lift all their restrictions and go back. So this is where I got concerned. And this is my concern. My concern is that the nice gradual decline of the expanding cases of the virus, 100%, 50%, 35%, hopefully next week 20%. But even if we're at 20% next week, we're still going to be at 1 million cases. So that's my premise. That's why I'm still very cautious on the market, despite the fact we're now at 500 points on the Dow. It doesn't matter. Yesterday we were down 500, so it's stupid. But the bottom line is, it's the premise that I have is that I'm very concerned that if they're actually going to open up states, you're going to see a spike back in levels, and we're going to take a huge step back. In other words, if we were 35% this week, and we were 50% the week before and 100% the week before in growth, a week. If we open up the states too early, and next week, instead of going down 20%, we're up 50% in cases, then we have taken a 2-week step back, right? Then we're back to where we were after the week that we grew 100%. And if we aren't learning our lesson by then, we could easily go back another week to 100%. And then what does that mean? That means that even if we go back to being as strict as we were, as strict as we are now, or as strict as we were a week ago, anyway, let's say that. If we go back to being as strict as we were a week ago, immediately after realizing what a colossal mistake we've been, we have still lost 2 weeks of additional lockdown time, just by making one mistake in a week. We've extended the hardship by 2 weeks by making one little mistake. If we continue that mistake, we can backtrack a month easily. And by the time you undo the mistake and get to the point where and start putting the protocols back in place, you could lose a month, 2 months easily. That would be, it's a fatal mistake. It's literally a fatal mistake for the US economy. And you don't have to make it because you simply don't take that risk, right? Like, gee, if I only, all right, go, let's, going back to, I forgot what even started with, Viacom. Okay, Viacom can make, I forget what the number was, 3,000 to 50,000, 15 times your money. Viacom can make 15 times your money, but you have a risk of being assigned Viacom. So if you have, if you can afford to own $34,000 worth of Viacom, let's say you have a $500,000 portfolio, and you could easily afford to own $34,000 worth of Viacom. It's not going to kill you, even if it drops in half. So you say, fine, I can sell 20 of these and buy 40 of these. And that's going to make 10 times your money back. So the net of that spread, if you had, well, yeah, Mr. Smarty Pants. All right, so you have 40 of these for $5, and you sell 20 of these for $7. It's 14,000, and 40 of these at $5 is 20,000. So it's 20,000 minus 14,000, $7,000, and you would have $40,000 worth of spreads. Right? So what, oh, I lost my track again. 20 minus 14 is 6. So $6,000 becomes $40,000 if you do 20 and 40. All right? So that means wait, 20, 40, it becomes $40,000. 6,000 becomes 40,000. So you're gonna make $36,000. There you go, I don't have to do the math. So that one trade will make $36,000. Now, in a $500,000 portfolio, that's a nice chunk of change to make. That's going to add, divided by $500,000. That's going to add 7.2% to your portfolio, just that one trade, to take that risk. That's how you allocate the risk. How much money can I lose on that risk? Well, I can get assigned Viacom at $17. And I can lose all of it. So I can get assigned $34,000 worth of Viacom, and it can go to zero. So I'm risking $34,000. You're risking about the same as you can make in the portfolio. It's obviously it's not very likely Viacom's going to go to zero, but let's just pretend that's the risk for the trade. So that's a reasonable, prudent risk to make. So how could you wipe out your portfolio? You could put your whole portfolio into it, like I said I would actually, but I mean you could take my advice, take the whole portfolio, put it all on that, because if instead you bought $500,000 worth, what do we say, 6,000? So let's say you did 600,000 worth, which would be I think 4,000 contracts. Is that right? 4,000 times what do we say it is? God damn it! It's 6 minus 3. No, 6 minus 350. So it's 250. So it's 250 per long. There you go. So it's $2.50 per contract. You got $500,000 divided by $250. So whoa, 500,000 divided by 250, 2,000 contracts. So you can buy 2,000 contracts, and those 2,000 contracts will pay $10. So it'd be $2 million. 2,200 to 2 million. Right. All right. So you can take your $500,000. You can risk losing the entire thing, and you can make $2 million. So one stock can wipe out your entire portfolio, or you can make $1.5 million in profit. So you can do that. It would be exciting if you win, but you shouldn't do that, because if you lose, you'll have nothing. Okay? Whereas prudently, we can take a small risk and enhance our portfolio return enhance the entire portfolio's return by 7.5%, and we're only risking about 5% of the portfolio, or 7% of the portfolio. That makes a lot more sense, right? I think it's a good possibility. I'm willing to risk 7% to make 7%. Maybe I'm willing to risk 15% to make 15%. But I'm not willing to risk 100% to make 3 times my money, to turn my entire portfolio into this risk. Because the downside is stupid. And that's what it is with the virus, right? Would be lovely if it all works out and we all go back to work and nobody actually gets sick and the whole thing turns out to be not as big a deal as we thought. But you know what? The downside is we destroy the United States of America. That's not a good downside. Unfortunately, we have a president who is, and it's not an expression to say he's willing to risk that. It's a fact. He bankrupted 5 companies doing the same thing. He had some successes doing the same thing. And because of the way U.S. bankruptcy law works, you can do that. You can bankrupt yourself. As long as you don't give a shit about the collateral damage that you do to the people who invest with you when you bankrupt, you can go bankrupt every freaking day. If you can find more people to invest in you, it doesn't matter. Only the successes matter. And again, in U.S. law, when you build a business, you separate the business. You can have 5 successful businesses and 3 unsuccessful businesses, and the successful businesses don't suffer. Only the investors lose in the unsuccessful businesses. So if you are, and once you get to Trump's level, where he's got 45 building projects going on at the same time, and they all pay off double, triple when they win, and if they lose, they go bankrupt, then he doesn't care. It's not his money. He doesn't invest his money in these building projects. He gets investors. He's in the business of being a gatherer of capital. And he gets money together and he puts it into projects. And when the projects wins, he gets the money. When the projects lose, they go bankrupt, but he's completely insulated from the bankruptcy. And in the times he did put his personal money on the table, he bankrupted and other things. Some of his biggest failures were these casinos where he put a lot of his own capital in it or whatever. He learned that lesson though. After he bankrupted his last set of casinos, he never put money into another project again of his own money. And he started licensing his name on buildings rather than even getting involved in the building of them. He turned Trump into a brand. That's what The Apprentice was all about, was creating a brand for Trump, not Trump the builder. They're not his projects that he's talking about. They're other people's projects he puts his name on. They don't put their capital at risk anymore. So that's the mentality of the guy who's willing to bet the country on this working out. Because if it works out, he'll be looked at as a hero by at least half the people in the country. They will worship him as a god for bringing them through this thing and making the right moves and so on and so forth. So he doesn't care, though. He makes a coin flip. It doesn't matter what moves he makes, as long as he acts very confident, says that he's in control, and so on and so forth. If it works out, he's going to be a huge hero. If it doesn't work out, he's obviously going to blame a million other people and say it wasn't his fault. And the downside is the country is destroyed. But it's not his problem. The Trump family can just pick up and go to Uruguay. This is not their mess to clean up. It's ours. And that's why I'm pissed off. And that's why I'm very worried. Let's see. All right. So Theo says, I remember you used to like NLY a lot. Any idea what the virus impact on them can be? It's not so much the virus, it's the rate environment and the loan environment. And the problem is that they sell mortgage, they repackage mortgages, basically. They're a mortgage REIT. And the problem is they lend money. So they borrow money at 3%, they lend money at 6%. That's how they make their money. It's very simple. They're basically not much different than a bank. But the problem is everybody who they lent money to is refinancing out. Anybody they lent money to at a higher rate is going to refinance out of these ridiculously low rates. So all these mortgages that they were making, their income flow disappears. It starts drying up as people refinance all the paper they're holding. So they terminate the loans. Now they can't get money. Now NOI can't go out and get new loans at the same spread they used to get. It doesn't matter what the loan amount is. It matters what the spread is between what they can borrow for and what a loan costs. Now, when a regular homeowner can go and get a 3% loan or a 2.5% loan at the bank, then NOI has to pay a half a point or a point at the at the Fed or wherever the Fed bank they're getting money from. Their spread is only a couple of percent. That's not as much money as they used to make. Now, maybe they can make more loans, maybe they can do this or that, but the bottom line is it makes a harder environment for them to make money on. And of course, there is a certain percentage of defaults that is always going to happen, and that's the risk they take, and that eats into the profits that they make. But that risk of default doesn't change particularly just because the loan rates are lower. People are still going to go bankrupt and still lose their houses, and they're still going to get stuck with mortgages. So that's the problem with all the REITs. You don't know who's going to win and who's going to lose, and they're all getting sold off like crazy. Management-wise, I like NLY. It's the same management as CIM, but it is a very, very, very hard environment for these guys. And will they get through it? Probably. It's hard it's hard for me to turn down at these levels, but it's such an unattractive environment for them right now that I'm not jumping right in. We have NLY. I think we have NLY somewhere. But I wouldn't bail on them, having already taken a loss. I wouldn't bail on them, but it's not like a Viacom where I say I'll take my whole portfolio and put it in there. You got to be careful with these things. We're over time. Shit. Viacom. All right. All return on the puts. The NCS is almost no return. Yeah, well, well, it's not all the return on the put, but it's a combination. That's all. Yeah, the put the bull call spread has a 100% return. That's not that terrible, really. Viacom 5, 11, 15. So it's a $10. Okay. Well, B-Terra, I don't know what the heck you're talking about. So your question is Viacom, if you have a $5 put for 11 and you sell a $15 put for 6, how does that make 100%? Well, if you spend net 5 and Viacom stays over 15, you'll get back 10. And 10 is 100% more than 5. Okay, so that's the best I can explain math to you. Please, can you talk about CAR Carrier Global? Nope, we're out of time, Potter. Have to do it in chat room. So, I have not. Carrier is that the air conditioner Carrier, guys? I don't even know. So if it is, that's probably a good business if they're on sale. Let's see. CARR. Ew, that's weird. Where's the rest of their short? That can't be the air conditioning, guys. All right, anyway, thank you guys. Sorry about the technical glitch at the beginning, but we're all good now, and I will see you all again next week. All right, take care.